Hey everybody, welcome to This Week in Pre-IPO Stocks podcast. With me, I got Nick Fusco, CEO of ApeVue, a pre-IPO secondary market pricing company, and Clint Sorenson, Chief Investment Officer at WellShield, an outsourced CIO and investment research company. All right, we got like a special podcast this week. The SEC came out with some new rules for private funds, so we wanted to jump in those in kind of detail, right? So for those that aren't familiar, a private fund is like a venture capital fund, a private equity, private real estate fund, etc. Most of those are like LPs out of Delaware. Sometimes they're offshore, right? They have a general partner, and most of the time they have an investment advisor, right? So these SEC new rules for private funds are for investment advisors that advise these private funds, and these are some new rules that they have to follow, right? There was a handful of them, and there's a great fact sheet that the SEC put out, but there's really three that I think are really important that I wanted to focus on with Nick and Clint today. And that's really around like performance reporting, kind of third-party valuation on secondary transactions, and then preferential treatment and kind of side letters, right? So first, maybe we'll talk about performance reporting. So performance reporting, there's a couple different criteria. To me, it kind of summed up is it almost starts to look like a fact sheet, right, on a prospectus, like you would see for a mutual fund or ETF. But really what I think was interesting, maybe for us in like kind of the pre-IPO space, this idea around performance reporting. So you have to now required to send out performance reporting. And if you're in this pre-IPO space, like, right, Nick, like this is a big deal. This is what really kind of what ApeVue does, that your company that you're the CEO of is helping auditors and others, kind of come up with marks on their business. So now if I'm on the hook, if I'm a GP or investment advisor on one of these private funds and I want to mark my book or I have to provide this performance reporting, I kind of need to make sure that the performance reporting is accurate, right?
Absolutely.
So yeah. So what are your thoughts around kind of this performance reporting item that the SEC put out there?
Yeah, I think thematically we're making things just much more standardized, and there's going to be a fair bit more rigor that goes into it. And the way we've built our business and our whole model was we kind of saw a lot of this kind of in the pike because we previously worked on other asset classes where this occurred as well. So if you look back 10, 15 years, it was FAS 157, the leveling 1, 2, and 3, which became ASC 820, trying to arrive to fair market value to the best of your ability.
Okay, hold on. Can you explain that real quick? Because I know what that means. Because you've explained it to me. But could you, like, just do it like 2 minutes on what that means, right?
So tell me, like,
you got it. No, of course. No, okay. So at the general sense, a fund is going to want to arrive to a fair value for its assets, and there are three main categories within that fair value. If you're a public fund and you're trading Ford Motor Company, it's going to be pretty easy. It's listed on an exchange traded. We know that the value at the end of the day at 4 o'clock is going to be a pretty fundamentally good value, we hope, right? So that's considered a level 1. Level 2 is really going to be things that maybe trade less frequently, but there's still market activity for. So it's market-driven activity. And so that would be a level 2, rather. A level 3 is more model-based inputs. So making assumptions as to what goes into the creation of a mark when it's not something that's actually transacted on or marketed. So what we're really hoping to do is we're looking at the private sector here for late stage or growth stage pre-IPO names. You have it. A lot of those were based off of maybe last round, which is maybe a bit more subjective depending on how long it's been since the last round, because it's not been 6 months, it's been a year or 2 years or 3 years. Maybe based on discounted cash flows, which you'll have to bring your own assumptions into, or public sector comparables, which again you bring your own assumptions into. We're trying to elevate that and bring it to more that not level 3, more model driven, but markets driven. So where bids, offers, and trades are occurring in the absence of distressed sales. That's how we look at that ASC 820, levels 1, 2, and 3.
Got it. So then Clint, like you're allocating to funds, right? When you talk to your managers, are you asking, because most private funds have just the GP gives the value, and then there's like an audit at the end of the year, right? Are you like are you kind of relying on those annual audit reports as like the primary valuation, or like how do you think about valuations in private funds?
So from due diligence, right, the annual audit reports everything, but we also validate, right? So we're checking around market sources. I mean, you could tap into an ApeVue, for instance, which we haven't up to this point, but I plan on doing, right, in terms of saying, hey, where is something trading or whatever, right? It's been kind of the Wild West. It just on the spirit of these changes, I like it, right? I think that when you have markets the way markets are today, where the public markets are inherently shrinking, private markets are such a big market when you're thinking about getting diversification and access to different areas and themes, et cetera. Like the SEC is a consumer protection organization. So this is just all tools to make these type of investments more digestible to the consumer and make them more pari
Right.
passu to what they're typically used to. So I
Right.
love the spirit of it. And to Nick's point, I love the added rigor to it. And so this is just going to be helpful for people like me who are working with investment advisors every day and allocating to funds. And it's going to be extremely helpful for the consumer. At least I hope so, right? I think that's the spirit of the rule change.
Okay, fair enough. So this kind of dovetails into the next item, which also I think has to do with pricing, right, or valuation. So there was kind of this mandate for secondary market transactions that are advisor led, and especially, Clint, we were talking about this earlier. This primarily seems to focus on kind of like what I would call like self dealing. So one GP, the same GP on one fund or another fund or affiliate is buying LP interest of another one
Yeah.
within kind of the same company. So that would require a third party now to kind of bless the valuation of what that transaction happens, right? So like Nick, like back to you, man. Like this that that seems to be like a calling card for like an ApeVue price. You know what I mean? But like talk to us about the dynamics of how that works exactly, right? Because I think right now, like if I was running an ETF, which I have in the past, right? And then we got a price from that level one where it was a market price, like I could just call a pricing data company. I could get a feed from New York Stock Exchange. I can
Right.
get a feed from a lot of places, and I could just use that price.
And that's $5, right?
Yeah, it's like not that expensive.
Yeah.
But this is different, right? So like talk about how that process works.
From the first one, because you're going to need a fairness opinion or independent valuer to come in and opine on the pricing of that stake to be appropriate before it's going to be done. Now, I mean, we ended up getting way ahead of this regulation, so I think it was April of 2022. We responded to the SEC's call for open letters to come in, and this
On
was a big.
on this thing here, you did? Oh, I didn't
Yeah,
know that.
exactly. Oh yeah,
That's cool.
we were way ahead of this.
That's
So
cool.
a lot of it will also come back to who wants to do these fairness opinions.
Mm.
And what we've read in our due diligence was it's a decreasing number of firms that actually want to come in and bid the administrator or advisors on this
Okay.
because the legal liability is getting higher and higher, right? So let's say that
Uh,
you're doing a trade and John Doe comes in and provides the service for you, and it turns out that was wildly off. There's going to be a lawsuit, and guess what? John Doe is getting dragged into it, or his services company. So I think you really want to look at again what is going to be highly independent. So what is a either we look at it in a consortium basis. We take marks from all brokers that are in our consortium, commingle those based on quality metrics, make sure we're rejecting outliers, make sure we're rejecting duplicates to create an end price that could then be provided to them to help facilitate that process. And I think this is also compliant not just to the fair value aspect, but to the PCAOB, so for public accountant best practices, and it
yeah.
actually looks very similar. I hate throwing out more like codes and numbers and acronyms, but like what mutual funds deal with recently, which is Rule 2A5, that they have to periodically assess when there are new ways to approach evaluation that could be better than how it's been done previously. So let's say comparing an independent price from a company like our own
Yeah.
to using the last round. Last round was really good when there
Right.
were consistent last rounds all the time, but it's
Right.
becoming less relevant. So that would be how that would come in. And I think the price point on those really starts. Maybe I'm a little bit off on this, but it could be 10,000, 15,000 on a per issue basis.
Right.
So if you've got a fund with 10 positions, or your code 2 or T1, and you've got 50 or 100 or 100 plus positions, all this starts to really, really, really add up if you want to be able to facilitate these LP stake transfers, right?
Yeah.
So we're just trying to make that easy and make it actually look much more commensurate to, you mentioned ICE or Reuters or FactSet and Market and whomever, but it should look a little bit more like that process as this gets a fair bit more organized, and it will potentially bring some of those price points down as well, the cost.
Yeah, I mean, that really resonates with me too, but also I think that the point that you make about mutual fund companies having to constantly be looking to see if there's better pricing opportunities out there. Like, I would much rather go with an ApeVue price than some price that an auditor came up with, like, out of a spreadsheet, right? Because that, like, the ApeVue is like real world, right?
Well,
So
mark to model versus mark to market, which is
right. I mean, historically, I mean, part of the reason why we started the company, about 3 years ago and came at it, was because we looked at valuation practitioners out there, and if you have a position in Stripe and so do 19 others, I'll be willing to get that all 20 of you could actually get different valuations from the same provider. Mm-hmm. Whereas if we have the same 20 clients that also own Stripe, all 20 would get the same as long as they own the same class, right? So right. That's how we would look at that in a very different lens, and it's exactly what Clinton is saying. The market's based, and I think it also becomes a bit more audit proof when you're able to. I mean, we just found out before the call we have some mutual auditors on the line, which is great, but those auditors go through the rigor of reverse engineering the inputs and the calculations to find, is this a reliable price? And It's actually consistent. It's been what's done across many other different asset classes for the last 2-3 decades, right?
Right.
I think that robustness was lacking in the market. And you're giving me airtime to do our origin story, but this is a big part of it.
It's relevant, yeah.
Yeah, and
it's
that's
relevant,
why.
But also, it's like changing too, Nick. Like, because I think as the secondary market, at least for this late stage venture stuff, I mean, these rules apply to all asset classes in private funds, but
real estate,
as it becomes more liquid, like companies like ApeVue can exist, and like things just need to naturally evolve, right? I think you're kind of getting that. Maybe these rules help accelerate it, right? But Clint, let me ask you. So you were mentioning earlier, right? You were giving some examples of like private equity funds that were that were involved in a lot of these transactions. Like, what's your experience with some of these GP, advisor-led, secondary transactions?
Yeah, so like I think definition of these secondary transactions is important, right? Because it's the fund trying to sell off a portion or all of that LP's investment in that fund to another vehicle that they're driving, right? So whether it be spinning off into an SPV or whether it be, it's just a liquidity measure that's internal is essentially the way I look at it. It's providing liquidity for the fund or for these LPs through another vehicle inside. So it's going to apply a lot to the bigger firms who are hearing about doing this right now, where they have a fund, private equity fund, clients, LPs, maybe the ones that get preferential treatment, which I know we'll hit on a second.
Yeah.
Maybe those type of LPs want liquidity. And so they provide liquidity by buying that stake in a different vehicle controlled by that advisor. And that can be perceived as shady. It's not an uncommon practice, but I think that's what the SEC is out here doing, is saying, hey guys, if you're going to do that, it's got to be fair and above board and transparent to the consumer, to the LP. And I think that's what this is all after. And again, it just keeps pointing me back to the value of this data and the secondary market data, not only on individual names, but even on these stakes. And so, Nick, I think you've got a bright future, my man, and ApeVue as well, because I think this is super important for investors in this space and in private markets.
Yeah, absolutely. Okay, all right. So the third item that came up was this preferential treatment, and where, in particular, there was some information rights and some redemption rights and some other things. But the thing that maybe I'd ask us to focus on is this is around economic terms, right? And the way that I read this, and you guys tell me if you read it differently, but this is really kind of focused around disclosure. So if I have a side letter that I've entered into with somebody, I have to tell all of the investors in the fund that I just did that side letter, which prior to you didn't have to do that, right? So if I'm an LP in some funds, which I am, and I'm paying certain fees, and then I find out that there's somebody else that got different fees and that person looked just like me, I might be a little salty about that, right? Or I would be. So like Clint, like talk to me, man. Like you're allocated. Like how would you feel? How do you feel about that? What do you think's going to happen? As a result of this additional disclosure, like where will this all go?
Yeah, I mean, for some of my private fund business, this is somewhat annoying. But when you think about it long term for the consumer, this is great. This is again back to transparency, back to standardization. This is really professionalizing private market investing in a different realm, right? And I like that aspect of it. It's just a pain to me who executes side letters all the time that now if I have to do a side letter because someone's committing a large amount of capital to me, I've now got to share that with everyone. So everyone's going to be calling me wanting the same deal. That's frustrating as an advisor on some funds, right? So I think what's going to end up happening is just, again, going back to standardization, think about mutual funds, breakpoints, right? Because what are most of these arrangements are from either someone helped you a long time ago and they were an early investor, maybe your first fund, and you're on fund 15. And you're like, hey, I know you don't commit as much capital to these institutional partners, but we're going to give you the same kind of friends and family terms. I think that's going to be easy to be standardized if you say, hey, for our friends and family or a founder share class or whatever you want to call it, they get this side letter and you disclose that. I don't think people are going to have a problem with it. They understand the mechanism. And then you have breakpoints based on capital commitments.
Right.
I think that's also going to help a lot with this. It's just, again, it's going to be somewhat of an annoyance, but I think that it's better long term for the industry and better for the consumer.
Yeah, I mean, I could see standards like a lot of this stuff is already kind of happened. Like in 40 Act funds, mutual fund ETFs, all the investors have to have the same pricing. So you kind of seen where these things go to address items like you've just discussed. Someone's coming in earlier, or they have more money, or whatever it might be, right? I mean, there's definitely
share
things
classes,
that kind of are out there.
You have your I class.
That's right.
You have your I share class. I mean, these funds have tons of different share classes, and I think that's an easy solution. Right? It's just different share classes, and here's what qualifies for you that share class. So it doesn't become a side letter per se. It's a share class.
Yeah. Okay, so Nick, help me think through some of this stuff as it relates to dynamic in the secondary market, right? Because a lot of the trades, like I just did a SpaceX trade, so that's like a real world example, right? We raised money in a fund, we had assets in a private fund, we bought into another fund to buy SpaceX shares, right? So we bought into an SPV, a special purpose vehicle. It's a private fund. We bought into a private fund. The only thing they owned in that private fund was SpaceX stock, right? So, and I had a 0-0 side letter, right? For that fund. It's like literally exactly what this rule is about. So like the way that I read that now is that GP or that investment advisor that ran that SPV would have to go out and tell everybody else in the fund that they just did this. So of course, when some other LP in the future comes, they're gonna say like, oh, I want you to do what you did for that guy, right? For the guy who's going to buy my fund, because I can get a better price, right? For my LP interest. So do you think that that's going to have an impact? Do you think that's going to have an impact on pricing or the amount of transactions that can get done? Like, do you think GPs will be like, well, forget this. I'm not doing any of these 0-0 side letters anymore. Like the buyer and seller can just work it out, which adds more kind of pain, right, for buyer and seller for a transaction to get done. What do you think about? What are your thoughts there?
Yeah, it's kind of interesting, and if it does play out the way your situation that you just described would, wow, I mean that's going to change the dynamic in the market. But actually, I'll almost throw it back to Clint's comments. It could also drive further consistency in the way a lot of these structures go.
Smart.
Because in a lot of cases of what we're observing, we see an absolute ton of direct activity, and we see an absolute ton of 0-0 activity,
right.
And everything else is kind of the minutia.
Right.
And that
right.
might be a function of the area of the market that we play in. With the average size that we're observing is well in excess of a $1 million, more akin to like a $15 million transaction. And
right.
as you get up to that size, I think you start to see fewer and fewer 1 in 10s or 1 in 20s or 2
Right.
in 10s and 2 in 20s. You see a lot more directs and a lot more zeros. And I think that you'll end up actually finding ways to discount back what the appropriate price level is to make those transactions tie out to the numbers that are required potentially.
Yeah.
Actually, in 2006, I ran an index product that was used credit default swap type mechanism to short asset-backed securities, so home equity asset-backs. And everything we did to price that out was based on discounting back what the upfront lump sum would have to be to tie it out so everybody gets the exact same terms of the trade. So maybe that might be a little bit too far, but the general idea is hitting on disclosure. That's the theme, everything the SEC wants out. Leveling the playing field, consistency, we've all touched on that, and then the reporting aspect. This would actually make a lot of that more easier, and then also hitting on Clint's, you know what, yeah, even if you put leveling in there and put it all up, it actually might make the negotiation way easier. Hey, I can't do something special for you unless it's outlined in the way we've structured the fund. Might save us as I know this is going to take everyone a lot more time to accommodate, but actually certain aspects of it might save time.
Yeah.
If you just point your finger to the SEC and be like, sorry, there's
It is
no
what it
side
is.
letter.
Yeah, you move on.
Hands are tied.
That's true.
Yeah, exactly.
It's true.
Yeah.
And
I got the share class over here for you.
Call up Gary Gensler if you want to talk about it. Yeah.
Yeah, I think, but I got to tell you, Nick, I think you're right. I mean, but also too, Clint, I could see GPs or investment advisors or private funds just setting up a share class and be like, this is the LP secondary share class now. So I'll flip you from the primary to the secondary, and that's how these things will be now treated, going forward. And there'd be like some kind of conversion between those two shares. But Nick, I've had people quote me prices that had like a 2 and 20 structure on it, and it's a much lower price, right, than something that was 0-0, obviously. And they're trying to make up for the fact that, to your point, there's fees on that SPV. We had a little bit of that in a trade that I did prior. They were trying to come back, and they were like, well, the seller and I agreed to do 0-0. Okay. The GP was on the fence on whether or not they were actually going to give it or not. So there was a couple days time where they were like, well, here's the other options that we could do. One is they were going to change the price. Two is they wanted me to enter into a contract with the seller that the seller would pay the fees in perperpetuity. Which I was like, that's a hard no. Because the seller wasn't even in the US. So I wasn't going to rely on them to pay the fee. And then I'm the LP. Well, if they don't pay, they're going to come after me. Right. So there was that. I was actually pushing for putting shares in escrow, right, with an escrow agent. So that would address it. So we'll cut it here. This would be the split. We'll put the shares into escrow, and then those shares will grow, and that will be the 20%, right, or close to it. I felt much more comfortable with that because even when you model, especially with the companies that these venture companies, right? Even though they're late stage, some of them could still take off and be 4 or 5x. You don't know. What if it's 2x? What if it's 8x? That 20% can be material. And then you got to go. I have to go back to my LPs and explain it to them. So this dynamic of not having the GP go to a 0-0, I think is going to really be interesting to see how it plays out in the late stage, pre-IPO secondary space. But I do hope, like both of you guys said, I do hope it kind of drives us some standardization. It'd be nice if everyone just be like, this is how you deal with it.
I mean, and the ETF guy in you is coming right out. You're ready for it. 1940 Act.
I mean, but it all gets
see the book in the background, right?
Yeah, man. I mean, I think it all gets easier if there's some standardization of this stuff because, the money will flow,
Yeah.
Hopefully it's the right standardization. I saw something in that we were talking about it, and one of it said it does not apply to offshore entities. So
right,
all of a sudden you can get preferential treatment in your offshore entity. So
somebody had a very good lobbyist. Yeah, somebody had a very good lobbyist to make sure that the offshore.
I bet they're out of the Caymans. Yeah, exactly.
Yeah. Cayman,
big operation in the Caymans.
Yeah, Cayman fund administrators, welcome to yeah, that's right. That's right. I like
The
that. I like that. Well,
the
okay. Any other
the
thoughts on the SEC? Oh, go ahead, Nick. Go ahead.
No, I think I listened to the call, which amounted to well over 3 hours because there were two things up for play. I actually think I did see some offshore entity advertising in the background of Gary's video there. No,
Yeah.
but I also found it interesting that this was hotly debated on that call, and it
Mm,
was definitely not a unanimous decision in a lot of ways because I think Hester Pierce was the most vocal of the commissioners coming in and really pushing that. You know what? We're suggesting that we are at the protection of public money. So we're looking after teachers, we're looking after pensioners, we're looking after police officers, firefighters, etc. But her points were very much so. A lot of these folks that have these pensions are managed by some of the best uh, financial engineers in the world or PMs in the world, sitting at CalPERS, sitting at all the different funds that have more experience than just about every public fund manager out there. And she's
right.
saying, are we protecting this end of the market, or are we suggesting that these are the folks that are investing directly? But the vote ended. I'm going long-winded, but the vote ended up only being a 3-2 in favor,
Yeah,
as opposed
narrow.
to a 4-1 or a 5-0. So
Yeah, narrow
I
pass.
thought that was pretty interesting to have the narrow pass on something like this.
Yeah.
Uh,
Yeah. Oh, I mean, like, let's be clear. It only gets, I think, with technology, like this last week, we talked about tokenization, right? On LP interest, right? I think with technology standardization, all of this stuff, it just becomes more accessible. I think a lot of investors, I think, want the general public want access, more access to the private markets, right? And I think Congress and the SEC is trying to give that, right? So I'm not surprised to see, and I don't think this is going to be the last batch of private fund rules to start to make everything look like regular mutual funds, ETF, 40 Act funds.
right.
I mean, they're all 40 Act funds, I suppose, private funds, but like, they're going to start to look like these publicly traded security, funds. So I don't see this, like, I don't see a rollback at any point. I just think it continually to progress to kind of more of the standard, the standard that's out there. But any kind of last parting thoughts on these private fund rules?
Yeah, I'll just echo in a different way what you just said, that the pervasiveness of the asset class is everyone's net benefit, I think.
Mm-hmm. I agree.
Because now all of a sudden we are helping to level the playing field. I mean, the three of us, even from different perspectives, are actually making it more accommodative to enter in a confident manner into an asset class that was very difficult
Yeah,
to enter 10
opaque.
years
Yeah,
ago, right?
that's right. That's right.
So I think the SEC is going at this as a protectionist angle, they also may further encourage access to this market, which is a
Right.
wild thought,
Yeah.
highly ironic, right? And that may hinder the likes of the NYSE, Nasdaq, and bankers that want to take a lot more public. So
Yeah.
really, I can't wait to see what the long-term repercussions of this are, but there might be some benefit for private markets, like well beyond what the SEC
I
would have
agree.
thought.
That's well said. I mean, Clinton, you work with, you know, independent wealth management firms, and they all work with individual clients on the other side. But like, I know in your asset allocation model, like you're the CIO for these firms, right? So you're advising these folks to start adding more alternatives, right? Which I think prior to they didn't really have a ton of alternatives in their portfolios, right? You're kind of adding that in now.
Yeah, I've been pounding the table on alternatives and private market strategies for several years now. Still not at the weighting that I'm recommending, but we're getting there. And I see it now, demand being driven by the end client, and that's something different. I think that's
Oh,
probably been the biggest change where
okay.
everyone thought of private market strategies as the, non-public REIT or the BDC, which was, those are pretty common vehicles in the independent broker dealer space. And I think now people are waking up to the size of the private markets, how accessible they are. We have better data thanks to people like Nick, and we have more access to strategies thanks to people like you, Aaron. So I think as access opens up, I think people's eyes are open to the quote unquote alternatives that are out there. And I think it's been, I think it's going to be beneficial to the investors. I mean, if you look at, I was with an endowment last week, and it's so funny. We were talking about endowment allocations, and if you look at the top performing endowments for forever, right, they're heavily in alternative investments, heavily in private market strategies, whereas a lot of the smaller endowments haven't had access or the ability to get exposure there outside of maybe fund of funds until recently. And now you have smaller endowments that are able to get a very similar allocation of these large endowments, and hopefully get the same type of risk reward, goals-based strategy that they're trying to pursue. And I think this is just I believe strongly in private market investing for end clients. I think it's better behaviorally. I think risk and reward. I think there's a number of reasons, right? But I think ultimately having that in a portfolio encourages and better investor behavior, which helps them stick to their portfolio longer, which hopefully helps them reach their objectives. And so I think this is all positive.
Love it. I love it. All right, let's end it there, fellas. This has been awesome. And I'm sure we'll have more to talk about this in the coming weeks, right? Especially as the lawyers get their hands on the stuff and start to flush it out. No doubt there'll be a Q&A. There's always a Q&A after these, right? You know what I mean? Where they come back and answer questions on implementation. So we could maybe do another one of these when that Q&A comes out. But